Hello, my name is Elliot Gu. I'm editor of Personal Finance and the Energy Strategist. Today I want to talk a little bit about some of the most important energy markets out there, which of course are oil and natural gas. Late last week, on April the 1st, we actually saw oil break above a key technical level, basically a resistance level that has been on the chart for some time. Oil first touched around $83 a barrel back in October. It touched that level again in January, and it touched that level again in about mid-March. And each time it touched that level, it sort of backed off a few points or even a little bit more than that, back down to around $70 a barrel each case. But this time, last week on April the 1st, we actually saw oil punch above that level, that $83 a barrel level. There are a couple things that are interesting about this. One is that although the dollar's been a little bit weaker over the last couple of days, we've generally seen a pattern of the dollar strengthening since last December. And typically people have been saying that oil prices have been basically a trade against the dollar. When the dollar's weak, oil prices are rising. When the dollar's strong, oil prices were falling. But the recent data again suggests that what I've been saying for a long time about oil is true, which is that relationship has really been much overplayed. We've actually seen oil strengthen and break to new highs, even though the dollar has actually been relatively strong. So what does this mean for oil prices? Well, from a trading perspective, I expect oil to rally up to around the $90 a barrel range pretty quickly. I think you could see that before the end of April. I do think we will see $100 a barrel oil this year. I would suspect that to happen later on in the year. What's the fundamental underpinning for all of this? Not just looking at the charts, but looking at the actual fundamentals. I think we're seeing pretty conclusive evidence that demand is roaring back in some markets, particularly the developing markets. I think in your developed countries, places like the US and Western Europe, Japan, you're seeing a stabilization and probably will see a pretty decent summer driving season this year. Why do I say that? Consumer spending data has been pretty solid for the last several months. It does appear that the consumer is sort of coming out of hibernation. I don't think you're going to see really strong growth like you saw back during the boom years, but I think you're going to see somewhat of an uptick in gasoline demand this summer, especially in the United States, and I think that's probably supporting the price. The other factor, of course, is supply. Yes, in the very short term, U.S. supplies of oil and gasoline look healthy in terms of inventory, but that's really not what's important longer term. What's important is new production coming on stream. And there, it looks pretty constrained. It looks like we're going to see probably falling spare capacity across OPEC throughout this year and 2011 as well. So how do we play that? Number of ways. In the current issue of the Energy Strategist, which I just posted today, which is Wednesday, of course, we actually talk about a handful, about a half dozen or more, fairly small to mid-sized producers based all over the world that are very oil focused. Now what I'm looking for in these plays is one of two things. Either they have a big exploration portfolio and plan to drill a bunch of new wells this year. What I mean by that is a company that has some land in a place like Africa, very popular right now, places in the Arctic like Greenland, and plans to do a lot of drilling in that area this year. The reason that could be a catalyst is as they announce results from wells, if they show any prospective fields whatsoever, it can have a really big upside surprise to the stock. The other thing is what I call a development or appraisal catalyst, which is simply a company that goes out and already has found oil and comes up with a plan for actually producing oil from that field. Now, as production ramps up, that tends to be a major upside catalyst for the stock. So that's another thing to look for. And again, in the latest issue of the Energy Strategist, I go through a number of those plays. Let's talk very briefly about natural gas. Obviously, the big story for most of the year has been that natural gas prices have been very, very weak relative to oil. In fact, that was the case last year as well. One very interesting data point that emerged earlier this week is that the U.S. Energy Information Administration, or EIA, which is a unit of course, the Department of Energy, actually produces a bunch of data that comes out every week, data on everything from oil and natural gas production to inventories to storage, etc. They actually have a very influential report called EIA 914. What it purports to do is actually measure U.S. natural gas production broken down by different states and the Gulf of Mexico. And what it's been showing over the last year, and this has been a major bearish argument for gas, is that even though the rig count, the number of rigs actually actively drilling for gas, has fallen, U.S. production has actually remained very buoyant. Now the problem with this is that there's been some real big quirks in this data. And what I mean by that, there's been really a lot of missing gas. Gas that was unaccounted for. Basically the EIA's 914 survey didn't match up with some of the other data releases they were putting out, like storage numbers and demand estimates. And so what they've actually said is that they were wrong. Their model was based on the patterns that were experienced prior to about 2005, 2004, 2005. And that was really before the whole unconventional shale gas explosion happened. Now, as a result, they've been vastly overestimating U.S. natural gas production. And they've said, particularly from two states, Louisiana and Texas, which of course are the fastest growing gas producing state, Louisiana, and the largest gas producing state in the country, which is Texas. So I think this could actually be a potential upside catalyst for natural gas. They're supposed to give us some revised estimates for recent data points at the end of this month when they release the April monthly natural gas report. And then later on this year, probably in the autumn, we'll actually get revisions for data going back several years. So what you're seeing is that what a lot of the producers have been complaining about for a long time is true. The U.S. has been overestimating, the government has been overestimating U.S. natural gas production. And this suggests that one of the main bearish arguments against gas just simply isn't true. Now, does this mean that gas is going to go soaring to 10? No. But I do think we'll see a recovery in natural gas prices off recent lows in the upper 3s, low 4s, probably up to around 5 to 6, maybe a little higher by the end of the year. How do we play that? Of course, any companies related to U.S. natural gas production, those particularly in your shale and unconventional gas plays, and also services companies involved with heavy exposure to U.S. natural gas drilling industry. So that's a little wrap up of oil and natural gas prices. Oil breaking to new highs, new recovery highs. I think we'll see 90 by the end of the month, 100 this year. Natural gas, I think the EIA data revision has been overlooked so far, although natural gas did rally on that news. And I think we're going to see a little bit more upside out of gas as a result. So thank you very much.